Today we have a very special treat for you. Todd Rogers and Margaret Smith are going to present primarily on real estate investing. This will probably be a little bit of a piggyback onto the Money Management 101 class that Todd did for you guys about a month ago. So without further ado, Todd and Margaret.
All right, well, thank you very much. I'm going to start off with really some simple thing. And Ben, would you help me with this power? Do I just hit the forward buttons?
Space or
There you go. Got it. Okay, I'm going to start out with some really basic stuff. So if you guys get bored with that, I'm sorry. I'll try to zip through it. But really, this is about how you build your net worth, okay? And what I'm talking about is your financial net worth. Obviously, there's all sorts of components to where you build your net worth in all sorts of activities, philanthropic, your family, all sorts of stuff. So understand, we're focusing on financial net worth here, not just net worth overall as a person. So understand that part of it. But anyway, so we're going to kind of zip through that. Building your wealth, okay? Increasing your net worth. Net worth is really the definition of it is basically your assets, what you own, okay, minus what you owe, okay, which is your liabilities. We call that a balance sheet in accounting terms, but it's your internal financial statement is basically what that ends up being. As you progress in your real estate career and you want to get more involved in investing, it's very important for you to have a financial statement because it'll certainly help you in trying to borrow money so that a lot of times banks are going to request a financial statement. Well, that's nothing more than a simple balance sheet. And a balance sheet basically, again, is your assets minus your liabilities, okay? Pretty simple so far, right? So what are your assets, okay? Obviously, cash is an asset, right? Something that you have in the bank, something you have, okay? Investments, mutual funds, stocks, that sort of thing. Real estate, so anything you own real estate-wise is part of your assets that you have. And that could be your own house, could be your rental houses, beach houses, what have you, that you've able to accumulate. Other business partnerships, other businesses and partnerships in businesses. So if you have a partnership in a business, that's obviously part of your assets, right? It's part of something you own, you operate, and within that business, it would have its own balance sheet, but the net of that balance sheet would be whatever your percentage of that particular partnership is. And if you have other individual businesses that you own yourself, and again, you have a separate set of books for it, that sort of thing, obviously that helps comprise your assets. Okay, any cash value of life insurance. We kind of talked about that before in our 101 class. That's one of the ways that you can start building some cash and building some of your assets is through cash value of life insurance, okay? Personal property, cars, jewelry, furniture, use real values for this, okay? Obviously, you know, as soon as you buy a new car, you drive it off the lot, it's probably worth about half of what you paid for it, right? So don't kind of over fluff your personal assets based on some personal property items that you may have. But those are certainly worth something. So, so just keep that and any other assets that you might have that would be out there. What are liabilities? Liabilities is notes payable on real estate, your mortgage, okay? That's a liability, right? That's something that you owe, okay? Any home equity lines that you may have. Okay, notes payable on personal property. So if you have a car loan, okay, or boat loan, which again, if you took the other class, those are no-nos. You shouldn't take loans out for those things. Those should be saved up and written with cash. But anyway, anything else that you need to pay over a period of time. What things aren't liabilities are like your electric bill and things that are ongoing that are varied, that are actual expenses. And that's part of what's called your income statement, which I'll go over in just a minute. And do not confuse liabilities with monthly electric bills, phone bills, business expenses, insurance payments, etc. These are examples of expenses, again, figured on an income statement, okay? Any questions about how you calculate your net worth? Net worth is very simple. It's your assets minus what you owe equals a bottom line number, and that's what your financial net worth is. So any questions on that? Fairly simple, right? Okay, well, good. So example of a balance sheet, again, just giving you a real quick example, cash, personal home, rental home maybe, cash value of life insurance, personal property, total assets, liabilities may be notes payable on your home, notes payable on a rental home, notes payable on your auto, total liabilities, and then you come up with your net worth. Again, very simple calculations. It's never too soon for you to start at least putting these things down, and then look at it maybe when you first starting out, maybe once a year. But after that, and as more progress you get in your financial health, if you will, this would be something that you probably want to do every quarter. You just kind of see, hey, have I paid down my mortgages? Has our house gone up in value? That sort of thing, and just kind of recalculate these, because it's always good to have, again, especially if you're considered being in business with for yourself, being a realtor right now, and that being an independent contractor. One of the things, if you're applying for a mortgage or any kind of loan, this is the type of things they're going to want to know anyway, so you might as well kind of have it updated as often as possible. It gets more fun, obviously, the more things you have, okay? And obviously, we would love for you guys to concentrate on this side of the equation and maybe not on that side of the equation. In other words, the more things that you can buy without having to borrow is better for you. If you do borrow, there are certain things that you should or should not borrow on, and we went through that in our first presentation.
One other quick thing, Todd, I'm a certified financial planner, so I spend a lot of time looking at individuals and families' balance sheets, day to day. And as you're building your balance sheet and as you're thinking about ways to save and invest, nobody in this room's balance sheet is going to look exactly the same. Everybody's going to have kind of a different compilation of assets and liabilities. So there's no right or wrong. I would say, Todd gave kind of 4 different types of assets: cash, insurance, a residence, and real estate. The strongest balance sheets have some diversity between those different assets. Not all of your eggs say in one basket or another. That's
Correct.
your comment.
Yeah, that's awesome, and awesome to do. And Margaret's exactly right. The different variety you have, especially if you start new businesses, any of things like that, those are all really good stuff. So your income statement is basically, this is, if you think about it at the end of the year, this is kind of what you put together for your accountant to figure out what you made that year and how much you owe in taxes, or potentially get back in taxes, depending on how the case may be. Typically, it's more what you owe in taxes, just to let you know there. And a little side note to that, I was told by a really wise man like 25 years ago when I was complaining about paying taxes, and he told me, he said, the only one thing worse is not paying taxes. In other words, meaning you didn't make any money. So just remember that. So anyway, it's one of those things, necessary income minus expenses equals your profit. Your profit is amount you have to increase your wealth. And what I mean by that is if you have a certain amount of income, you have your budget put together for your expenses, and you say, my goal is to make, and I'm gonna use rough, easy numbers, $100,000, okay? And I'm gonna save $25,000 for taxes. That'll get taken off the top, as you'll see in just a minute. And then I have my mortgage payment and all those other things I have to do. Then what's left over, you ought to really, really try to concentrate into putting into more assets and putting into more things that are of value. Obviously, this example today is going to concentrate a little bit more on rental houses and things like that, and how that can really domino on you and really get you some good equity and good net worth there. So examples of income: real estate commissions, obviously, interest income on CDs, rental income, other business net income, okay? But basically anything like that, and I'm sure there's other forms of income out there, but basically it's what you give your accountant at the end of the year that shows, hey, this is what I made, right? Examples of expenses, okay, mortgage payments. And understand mortgage payments is the whole mortgage payment is tax deductible. Does anybody know that? Okay, is the whole mortgage payment tax? What portion of your mortgage payment is not tax deductible? Principal, the principal payment, okay? So the portion of your payment that you're paying to the bank that goes and is applied to principal is not tax deductible. The interest is, okay? Depends on if you, obviously you can talk a little bit more about if you separate out your expenses and itemized deductions and that sort of thing. So maybe you can talk a little bit about that.
So if you, the tax law is such today that if every taxpayer is always allowed a choice of whether they want to, ready?
There you go.
They want to take the standard deduction, which is a deduction that everyone gets. The IRS gives everyone a standard deduction, whether you're single or married filing jointly, the amount differs. Or if your itemized deductions exceed that standard deduction, you can actually take your itemized deductions to offset your taxable income. And the things that are itemized deductions are your mortgage interest, real estate taxes, and then the taxes that you pay to the state of Virginia or Commonwealth of Virginia on your income taxes. That category is kind of capped. And then any charitable donations that you have. So, the standard deduction is pretty large today for a married couple. That's like $28,000. It's hard for a lot of people's itemized deductions unless you have a really large mortgage or you're really, philanthropically inclined to exceed that standard deduction. But in certain instances, you are allowed to take a deduction for your mortgage interest, on your Schedule A of your taxes.
Exactly. And one thing that she just mentioned, and we'll kind of gloss over a little bit at the end, is depending on where you are and where your philanthropic goals are, remember that anything that you give to a qualified organization is also tax deductible. So, and that's just something that we'll talk about a little bit later. Household expenses are other, and again, these are not tax deductible expenses. These are just examples of expenses that you run every day that you're just trying to figure out how much money I have left over. So it's very similar to the assets and liabilities, but anyway, and then expenses as a percentage of your income. This formula works, the income's up to $200,000. So understand this, it's an example. Don't, it's just an example, okay? This formula works. So household expenses around 40%. And if you go back to the other class that was taught, you'll see how this kind of falls in line with that, okay? Mortgage payment, utility bills, food, clothing, insurance, etc. Income taxes, I mentioned before. The biggest mistake most realtors make new in the business is they get their commission check and guess what they do with it, Kevin? Spend it. Spend it. They forget about the IRS, okay? You got to make sure you take care of that. Always recommend you set up some sort of savings, you do something to do that. Get with a very good CPA like we have here today and make sure that you're disciplined in that, because we have seen over the time at Hometown Realty over the last 35 years of so many people failing in their second year, not because they didn't make money, it's because they didn't save for the taxes. The IRS is coming, and therefore every time we get a check, Lisa sends the check to the IRS instead of to Kevin Long. Kevin's not in check, but anyway, so income taxes, make sure the business expenses. So y'all especially, make sure you understand what your business expenses are. And I'm gonna turn it back over to Margaret. She can give you some real good ideas of your business expenses as a realtor.
As a realtor, so my favorite, I'll start with my favorite, which is the ability to put money into a retirement account. For self-employed individuals, that is oftentimes can be your largest tax deduction. You can also deduct things like mileage or actual expenses on your vehicle, any kind of meals and entertainment that you have that are for clients, you can certainly deduct those. Any costs that go into you running your business, if you're buying, any kind of collateral that you're going to give out to clients, what's no longer deductible is entertainment, taking people out, and the actual cost of like the tickets if you're going to a sporting event or something like that. That's not deductible anymore, so I would steer clear, of that. I mean, not do it, certainly, if it helps your business, but don't do it from a tax perspective. And really, it's at the end of the day, anything that you have to spend money on to produce commissions in your business and in your job, generally is tax deductible.
Any kind of marketing expenses you have, any kind of internet you do, any kind of social media stuff that costs you, anything like that is going to be a business deduction. So just keep track of those also. Charity vacations, I was very good with this to put vacations next to charity. We would love that to be a little bit different, as you can imagine, but as you're first starting out, it's hard to do those things. But vacations, I'm going to give the same example as I do for taxes. The only way you're going to afford to go on vacation is budget for it, is to be able to budget for it and save for it. Very, very easy to talk about, extremely hard to do, okay, and I understand that. But if you have, you want to go to a certain place and you need to save X amount of dollars, and you think based on the formula that you're going to be able to get there in 2 years, then be diligent and say, I'm going in 2 years, and this is the way I'm going to get there. Okay, so save for that also. And then investment savings, again, That's basically what I call your profit, if you will, from your personal financials. The money left over, that's what ought to go into increasing your net worth and investments and savings.
One other quick thing that I'll just, I've worked with some realtors that are just, have started out and started their business. And as Todd said, the biggest mistake is if you don't set aside enough from a tax perspective. And so, I usually tell them at the start, 25 to 30%. Start there. Every check you get, set it aside. And what I typically find is that at the end of the year, when all the taxes are paid for 2023, there's usually a little bit left over in that tax account. And that's your vacation. That's the time where you might kind of use that extra. If you haven't otherwise been able to kind of manage your budget and plan for it, it's sort of a freebie. You've forced yourself to save by setting aside 30% of every paycheck. And maybe you go a little bit higher if you just know that that's the way that I'm gonna set aside some money to either fund a retirement account or take a vacation or whatever the case might be. And I know, several of you in the room probably have other ways that you manage that, quarterly, but I've always said if you stick to 30%, get close to 30%, start at 25, get close to 30%, you're probably gonna have some money left over at the end of the year to make a decision on, do I wanna spend it or do I wanna save it?
Yeah, and the only caveat is if you get to the end of the year and you've counted on some extra money and then it not be extra money, then you just basically tell your family you're not going on vacation.
That's right.
I mean, that.
Todd River House.
Yeah, that's right. But anyway, so 2 ways to make these percentages work. Increase your income, very easy, right? The best way to do anything is increase your income or decrease your expenses, okay? So easy. Again, easy said, hard to do. By doing any of these, you'll automatically increase your net worth. It takes discipline, hard work, and big picture thinking. What I mean by big picture thinking, and we'll talk about this in just a second. If you don't think about where you want to be financially in 5 years, 10 years, 15 years, you'll never get there. If you think where you want to be next year, and then 5 years, and then 10 years, and then next year look at it again, and do 5 years and 10 years, and keep focusing on those things, you will eventually get there. You'll have it sitting out there in front of you, and that way you don't have to think about it. You have a great year one year, and you say, okay, I'm going to make sure that this amount's going to go here, and that really starts taking care of my plan for 5 years from now. I'm doing it already. Well, then you kind of start all over at the beginning of the year and say, okay, I've done that. I've done the 5 year. Now my new 5 year is here. This is what I want it to look like. And again, like Margaret mentioned in the beginning, that's different for everybody. Everybody has different aspirations, different ways they want to get and where they want to be financially, but none of it gets there by sitting there waiting to make a plan and waiting to say, okay, well maybe next year I'll have a better year and then I can put some money away. Well, no, next year I'm planning on making this based on how I'm going to do my budget, how I'm going to do my personal budget and my business budget. This is what I plan on making, and with that, I'm going to have X amount to be able to invest in my future that's going to help me get to my 5 and 10 year goals. So constantly relooking at that, I think, is very helpful. Okay, even as you get older, look at those things, because believe me, it changes year to year very easily. So all those things change depending on what's going on. So if there's a mechanism that was available to you to save money on taxes and increase your net worth by someone else paying with it, wouldn't that be great? Okay, so and again, this is what I'm going to just call welcome to real estate investments. Okay, so we're going to go into a little bit of real estate investments. We're going to use examples of just one rental house, okay, and give you an example how that over just a year can, with the right purchase, would have it over just 1 year, how you can see the net effect of your net worth just by purchasing one rental house. Okay, so I'm going to take you through an example investing. I just said that, so look at that. I already knew what I was going to say. Rental home investment. So let's say you find a rental home for $200,000. Make sure you understand this. I did this presentation probably 5 years ago, so I didn't change many of the numbers. Here's the other thing, is that, and we'll get to it in a minute, but I'll talk about it now. 5 years ago, what do you think a fixed rate mortgage was?
5 years ago, 4.5.
What do you think it was?
5 years ago, it was probably 4.5.
No, it's closer to 6. Yeah, investment loans were 6 and 7/8.
Oh, investment loans.
Well, this was a regular mortgage was right around 6. But anyway, regardless, it goes up and down. So just
That's crazy.
yeah, it may have been 6 years ago actually when I did this. So yeah, 2017. So 6 years ago.
You could buy a 200,000 rental, right?
Yeah, you could buy a $200,000 rental. Obviously, these numbers are a little off based on that, but anyway, we're gonna run through this, whatever. So your down payment, you can actually buy rental property, some for 10% down, most of them are gonna be 20% down, but I'm gonna use 10% down just to show you what that looks like, okay? So your loan amount, obviously you put 10% down on 200, your loan amount would be 180,000, okay? So you cash in, your closing costs, whatever, your total cash invested at that point is 25,000 under this example, okay? So monthly cash flow, and everybody talks about this. As far as monthly cash flow is concerned, on rental houses, don't be so caught up on, gosh, I gotta make $100 a month off the cash flow. If you break even, especially during the first couple of years, the cash flow will come, okay? And don't count on the cash flow, okay? Use the cash flow to reinvest. But anyway, so monthly cash flow, obviously you want the property cash flow. Monthly principal and interest, again, that was figured on 6 7/8%, which I thought was funny because of where interest rates have dipped and come back up. Real estate taxes, insurance, all of those are your expenses on your house, okay? Rental income, again, that's obviously way up now. So if the 200,000 is up, the rental income would be up also. But again, this example does this. So my whole thing was, let's just say you only have monthly cash flow of $7. Nobody's saying, I'm not making any money. Why? That's the dumbest thing in the world. I'm investing this money, I'm not making any money, okay? Really dumb thing that people sometimes get caught up on, okay? And again, the principal and interest is based on 6 7/8 with a 30-year mortgage, okay? Tax implications, okay? So you get 12 months of rental income, okay? That's gonna come in, that's gonna go on, you'll give it to your accountant, and they'll fill, what's the form called?
The Schedule E, or
Schedule E.
8825, depending on business, yeah.
Yeah, so the accountant will figure this part out, but this is, again, high level, okay? Your expenses that come out, your interest, again, you can't deduct your principal, okay? Understand that. The interest on that mortgage, $12,000, real estate taxes, insurance, and then there's this fun thing called
Depreciation, yay! It's amazing, it's amazing. That's actually writing off the value of the house itself over time. And so the IRS allows you to write off the purchase price of the house over 27.5 years for residential properties and 39 years for commercial properties. So if you hold the property for that long, you have no basis in that asset anymore. But it's not an outflow from you don't pay anybody depreciation, you get to take a deduction for it annually, over time.
Yeah.
So it's a non-cash expense.
Yeah, and it's really something good the IRS has done, in my opinion, over the years. And again, there's some nuances with that. If you buy a house, then you're supposed to figure out the value less what the lot is, because they don't let you depreciate the lot. They just let you depreciate
That's
the
right.
house.
You can never write off the land itself, just the structure,
Right.
And
And a good way to figure that too, I've always used, no matter what you buy the house for, is look at the ratio between the tax assessment of the land and the value, and it gives you an idea how much the land is of the value. So anyway, but detail there. But anyway, again, so then you say, gosh, this is kind of dumb. I've got $16,000 worth of income, but I got $20,000 worth of expense. But of that $20,000, how much did you actually come out of pocket for? Okay, much less than that, right? Because $5,800 of that is what, as Margaret described, a non-cash deduction in there. So your loss, taxable loss, is around $3,800 in this particular scenario. So why does that matter? I mean, what difference does that make? So your tax savings, if you're in a 35% tax bracket, would be $1,347. So even though you cash flowed your property, meaning that you collected enough rent to pay all your expenses, you really, in this particular scenario, you get about a $1,350 reduction in the amount of taxes you owe, or a better way to say it is that you would actually get that money back if you save properly on your income.
right. And this is unique. I mean, this is something that you all in the room can take advantage of that not everybody else can. You have to be a real estate professional in order to use this loss to offset your other income. So if you have somebody that's a doctor and they have a rental property, they can not pay any tax on that $7 of profit, but they have to carry this forward until they have other passive income that they can use it for. So this investing in real estate as a real estate professional really can give you a huge compounding benefit over time because of depreciation and the ability to use these losses to offset your commission income from selling a house.
Correct, correct. So anyway, let's, yes.
On that expenses, what about improvements to the property? If you had to go in and paint and you had to buy a new HVAC, where does that run up?
So depends, and we're gonna go through some of that in a few minutes, but it depends on what that item is. Painting is typically a straight line expense for the year. HVAC replacements are a separate depreciation, so you're not able to depreciate the whole thing. But if you have expenses on there, more than likely you're gonna be able to deduct it. If you're cleaning the carpets, repainting, and just getting the place ready to be released, that doesn't involve any capital replacements like HVAC, then it's a straight line deduction. It actually has to come out of pocket. But again, it's compounding, because if you pay those, then you also get that as a tax write-off. So then your loss becomes greater, if you will, under those.
Yeah, we're gonna look at a really cool example of that in a few minutes.
Okay. So your return on initial cash investment, again, your tax savings, we just went over that. Your principal pay down. So at 6 7/8, 30 years, $180,000 mortgage, you've actually paid down your principal by $1,875, or better put, your tenant has paid that down, right? You didn't really come out of pocket for that. The tenant, through the rent payments, helps you pay that. And then your appreciation. So let's say that and over time, real estate, we've got a graph that we looked at a couple months ago, that over a 20-year horizon, real estate properties in the Richmond area have increased an average of 4.8% a year. So I use 3% here just to give you an idea. Because again, the appreciation of the real estate is the other thing that you're working with to make sure you increase that net worth. So that's one thing that we would. So your net, if you think about it this way, your initial return on investment here includes the appreciation in the house, and improves any tax savings you have, and certainly the principal pay down, your liability going down, is all part of your initial cash return. So a return of $9,200 on initial cash investments, $25,000. You actually have like 36% return on that initial $25,000. You don't have $9,200 in your pocket. Understand that we're talking about net worth and how you build your net worth. Okay, so you didn't get $9,200 yet. Okay, you didn't get $9,200. But this is why it's such an important thing to understand, is investing, especially, and again, I'm a big fan of rental real estate, as you probably can tell, but investing in that now actually gives you returns that are much greater than you can get in a lot of different places. The other thing I like about real estate, and I say this all the time, is I can drive by and look at it.
Yeah.
You know, and don't get me wrong, you should be diverse, and everybody should be, and I've got some mutual funds and some stock and some other stuff, but not too much of that stuff. I can't go really touch that. You know, I can't really say, oh, give me my piece of stock, you know, or whatever. But I can ride by 123 Smith Street and say, there it is, I see it. So that's the reason I like it also. So now your new net worth statement, okay? Assets, $25,000 beginning of the year. Just say you only had $25,000 beginning of the year and you had no liabilities, okay? End of the year, your assets after your cash savings, your rental house, your liability to the bank, your net worth just had a net effect of that one rental house of $29,222, which that's the net that you end up increasing your net worth just by buying the one rental house through a year. Okay, I'm sorry, the net worth was increased by $4,222 after 1 year, because you had the $25,000 that you put in the beginning. So anyway. So end of the second year, you can kind of run through these numbers and see and how that continues to increase. So it was $29,000, then it goes to $38,000. Again, the notes payable to the bank is going down every year. The value of the real estate's going up. Your cash savings obviously continues to compound in there. So it's $13,710 just on that one asset for 1 year. All the above while someone else is paying for the tenant. I will tell you this, okay, and this is just this is an old-fashioned amortization schedule. I thought Rodney would like that. Remember that, Rodney? You know, but anyway, Y'all know what amortization schedule is, I hope, but if you don't, it's very easy. You have the total amount of the, so in this case, you borrowed $180,000, so the beginning principal balance was $180,000. After your first payment, you paid $151,000 in principal, $1,030 in interest, and therefore your balance is the difference between the $180,000 and the $151,000, and it keeps going down. And if you really want to have fun with this, you can do it out 5, 10 years and see how that principal amount just keeps coming down in there. But anyway, the one thing with rental houses, and I'll tell this to anybody, what do you think is the most important decision you're going to make after you buy the rental house? After you've decided you're going to buy it, you bought it, what's the most important decision you'll make?
Who you rent it to?
What's that?
Who you rent it to?
Great, that's it. If you scrub your tenants and do a good job of scrubbing your tenants, the nightmares you hear about things like that diminish greatly, okay? Not everybody wants to buy a house. I think you guys recognize that. Look at all the apartments, look at all the things that are going on around Richmond right now. Not everybody wants to or is ready to buy a house, okay? There's a lot of tenants out there that have great income, great credit history, all sorts of things that you would scrub. The biggest component I look at personally is what their rental history is about. Okay, so if they are renting a house from us and they've been renting houses for 2 or 3 years, I just look at the landlord report from them before that. That's really the only thing I need to know. Did they pay their rent? Did they pay their rent? Now, obviously, if they have a 400 credit score, I'm probably not going to take that either. So, but anyway, that's the biggest thing that you can protect yourself against any kind of thing like that. So, why real estate investments? It's the business that you're in. Kind of what Margaret said, we're lucky that we can actually use this as a tax advantage and build your net worth all at the same time, okay? Okay, you can leverage your investment for future investments. That's more what I'm talking about. As you build your financial statement or build your net worth, you can leverage that, meaning the banks will actually help you borrow against that. Commercial banks will, in order to buy other properties. So you can eventually leverage those for future investments. Okay, it's something I've mentioned a second ago, something you can see and touch, which is one of the things I like. Real estate, especially in the local area, has a history of always increasing. Look at properties over the last 10 years and see the increases. Y'all can Google that stuff. Yeah, you can do 10 years from now, you can do 20 years ago, what have you. You can find all that stuff out. What are the challenges with rentals? Finding the right property, okay, find the right tenant. Okay, we just talked about that. Okay, being disciplined and maintaining the property, kind of what Dean's talking about a little bit, being disciplined and the plan to continue to buy. Just like your business, if you say, hey, I want to get in the rental home business and I want to own 10 properties, because today 10 properties at $1,500 a month, if they're paid off in 25 years, which is a very achievable thing for all 10, okay, then in 25 years, based on today's dollars, you've got $15,000 a month coming in that nobody else is taking away from. So just keep that. What do you do in the end? What are the ultimate possibilities? Refinance, cash out, okay? Don't necessarily 100% recommend this, but I'll tell you something that has worked in other scenarios. Let's say you bought one rental house and it was worth $200,000 when you bought it, now it's worth $300,000, and you've paid off your mortgage. So you have $300,000 rental house, okay? And then you go to Abby and say, hey, I'd like to finance this, okay? I want to do a cash out refinance, and I've got 10 years, 15 years in the real estate business. This is how much money I make. This is how the rental's gone. And say she allows you to do a 70% refinance. Let's just use that as an example, okay? And it's worth $300,000. So you can do a 70% refinance of $300,000. That's $210,000, right? You literally can take out tax-free, okay? The disadvantage of that is if you sell it. When you sell it, you're more than likely going to pay taxes on the whole $300,000. So you've got to be careful with that and be disciplined with it. Here's another trick. Okay, and again, this is long-term planning, and I don't think I go into this. But long-term planning, let's say you take the cash out, $210,000, okay? Then you put a life insurance policy on that $210,000 for your heirs. So you put a life insurance policy on yourself that basically says that life insurance will pay that off if something happens to me and I pass away, okay? Then what happens when you pass away, here's another really, really cool trick. The value of the real estate at that point is $300,000, right? Okay? So you would think if the heirs turned around and sold it, they'd pay taxes on $300,000 because that's what they got. The IRS allows you to do what's called a stepped up basis, okay? When you pass it down, stepped up basis, that means the people that you passed it down to, they get the basis in the property of the value at your death. So here's the cool thing. You could have the $210,000. You could have blown it on anything you want. Put the life insurance, I'm not suggesting you do that, but you could have, okay? Put the life insurance policy on that so when you pass, there's no mortgage on it. It passes down to your child, your grandchild, whoever it ends up being. They now have a basis in the property of $300,000. They sell it for $300,000, no taxable gain. They get $300,000 with no taxes. They're a cool thing. So just keep that in mind as far as your long-term planning.
Yep.
Did I do that okay?
Yeah, you did. Oh, you can defer taxes forever. You're just not here, when
Yeah.
you have to pass it through your estate.
Pass it through your estate, you get
which is
what's
what-
called a stepped up basis.
Right, that's right. And, a lot of people will just continue to kick the can, buy more real estate, do 1031 exchanges, forever defer this gain, and then in the hands of the next generation, there's no tax.
Yeah, which is really a great way for estate planning. Let me back up, a great component of estate planning.
Yeah.
It shouldn't be your own, just like this shouldn't be your only way of investing. It's just a really cool thing to be able to pass down,
Yeah.
So anyway. Pass on future generations, tax-free, part of your estate plan. Gosh, there you go. Have the mortgage paid off for a future income source. So another really nice thing, you have a $300,000 home, it's paid off, you're getting $1,500, $2,000 a month. You gotta pay the real estate taxes and insurance on that, but other than that, you're pocketing the rest of the money. It's a great passive income source as you get into your retirement years, okay? And it just gives you options, okay? There's a very good friend of mine and business partner that says, man is only as bad as his options. Anyway, but that is, it simply does start to give you options as you have investments that get paid off. So other options to increase your net worth, starting to get involved in businesses that you choose the right partners, okay? Have good employees, be loyal to those and pay them good. Try to be the idea person and your partner be the ones that kind of go out and get some of the specifics done. Have a great financial planner. That is very important. Be able to share your financial goals with your spouse and your planner, and diversify your investments, what have you. Only do what you know. Don't get involved in the daycare business. That's the one thing that I learned over the last 35 years. Daycare business is a tough one. Gives you more choices of financial planning, okay? Enables you to achieve long-term goals and relative short-term time frames, creates opportunities for loved ones, grandkids, etc., nieces, nephews that they may not have ever had, okay? And responsibilities, talked about this, you must give back. You're successful, you're financially successful, don't keep it to yourself. Make sure that you have a philanthropic plan. Make sure that you've been given a special gift, and part of that gift is being able to give back. Make sure you do that. So anyway, passive income and capital gains.
All
There we
right.
go. Sorry.
So, I just will kind of reiterate, real estate and investing in real estate has inherent tax benefits that most other investments do not have. So that is very unique to investing in real estate. I probably kind of messed up my slide a little bit, so let me see. So just a few kind of high-level bullet points, and I think, this applies to all of you all, but you're going to get questions from clients and potential buyers and stuff like that, about how depreciation works, maybe, about how real estate is actually a tax-efficient investment. So I think this kind of gives you the ammo or the toolkit to be able to have those conversations with your clients. So just a few things that I'll kind of walk through. So obviously Todd talked about it. You can deduct the expenses related to the property. The passive income, if you don't have a bad tenant to babysit, you mentioned that having a good tenant is one of the most critical components to having a rental property. You've got passive income. Eventually that debt will get paid down. You will be generating more cash flow. The debt is locked in. That's a fixed payment if you lock in your mortgage for 30 years, but rents are going to go up. They're probably going to go up at that 3 to 5% range, just like the value of real estate is going to appreciate. So it generates passive income. You're earning money while you're not really doing anything, and that's a beautiful thing. Eventually, if you did sell a property down the road, it's not taxed like you going out and earning $100,000 in commissions at Hometown Realty. It's taxed less, often at capital gains rates if you did have kind of $100,000 of appreciation in a rental property. So that's a really good thing too. Anytime you can pay capital gains rates versus ordinary rates, for the highest tax brackets, your capital gains rates are almost half of that of ordinary income. It also has unique opportunities, real estate does, when it comes to kind of more complex or sophisticated strategies. Anybody heard of a 1031 exchange? That is unique to real estate, okay? I can't sell my Apple stock, not pay any tax, and buy Microsoft because I think that that's better over the next 6 months. Real estate, you could do that. You could sell one property, defer the gain by buying another property. There's this thing called self-directed IRAs. I think I would just caution you that you don't want to have, all your eggs in one basket. If you're buying a bunch of rentals and then also investing in real estate in your IRA, you can do that, but I would just say, you want to maintain some level of diversification. There's this new thing called opportunity zones. We don't have time to talk about that, but it was introduced about 5 years ago, and it was kind of a unique opportunity to tax save through real estate. Depreciation is that when you hear somebody like Donald Trump, and right or wrong, paid no taxes for all these years, the reason he did not pay taxes is because of depreciation and because of writing off assets. It is completely legal. It is, allowed in the tax code. It's just how do you choose and who chooses to take advantage of it and who is investing in things that have depreciation. And even better, my favorite is bonus depreciation. So it's kind of like depreciation on steroids. So let's kind of walk through an example of bonus depreciation. I'm going to sort of piggyback off of what Todd said. Remember, he said you've got your rent, you've got your mortgage, principal and interest, your insurance, and then this depreciation deduction. It was like $5,800. You didn't have to write a check for it. It's just writing off the value of the asset over time, okay? So in a base example, which he gave, if your house is worth $160, your land's worth $40, the total property was $200,000, on a straight line basis, your first year deduction is $5,800. Well, the IRS allows you on a rental property to go in and say, I'm not just gonna write this thing off over 27 and a half years. I'm actually gonna go in and I'm gonna identify components of this house. It took, flooring, it took tile, it took lumber, it took wiring, there's cabinets, there's landscaping that was involved, there's a paved driveway. I'm gonna kind of break this house down into its components, and certain components of the house you can take as a first year deduction. Write them off in their entirety. So this is just an example that I'll walk you through. The left-hand side is straight line. This is kind of the lowest level of depreciation you could take, the lowest level of write-offs. The right-hand side is I've gone in and I've done it's called a cost segregation study, and I've said between the appliances, the wiring, the carpet you can write off in your first year. The fans, the kitchen cabinets, countertops, all these things that have a shorter, it's called class life. I came up with $43,000 of those components on this rental house, the same $200,000 rental house that I bought. The IRS allows me to write it off in its entirety, plus a little bit more because I can still take the rest of the house that was not in this $43,000 over that 27 and a half year straight line. So same property, same debt, same $25,000 it cost me. All of a sudden I've generated a first year tax deduction of $47,000. That doesn't save you $1,300 in taxes, that saves you $16,000 in taxes if you have other income that could be used to offset. And again, that is unique for realtors. Now, I will say the downside is, if you've taken all these deductions up front, you're gonna have a little bit less deduction in that second, third, and fourth year for depreciation. It's an annual deduction, but we're talking about going from $5,800 a year to $4,250 a year in the second, third, and fourth years. Not that big of a deal, right? That's not, I saved $16,500 in my first year in taxes. Not that big of a deal to take a small haircut on my deductions in those subsequent years.
Yeah, and understand when Margaret's taking those components out, she's not telling you to go replace the appliances and that sort of thing. She's just taking the components that are in that house at that time. So I didn't want you to think you had to make an investment of 40-some thousand to get that deduction. Yes, sir.
What happened if you sell the house in subsequent?
Yeah. So there's this concept of recapture. If you've written something off and then you sell it for a value, you basically have to pay taxes on that amount that you've depreciated. So it wouldn't work if you say, I've got this rental house now that I'm gonna sell next year or the following year. You probably don't want to go through that exercise. But if you say, I'm gonna hold this thing forever and I'm gonna pay it off and it's gonna go to my kids, or I'm gonna cash out, refinance it, pay for college, whatever the case might be, it's worth it. Or even if you're not sure what you're gonna do with it, it's still, worst case is you gotta recapture it in a subsequent year, but you save money in the year that you bought the property.
And you can only do that in the year that you bought the property.
Correct, yep. So this is just an example of that cost segregation study that I said. I didn't do it quite, I actually used one that I did for somebody else when we were filing taxes this spring. But basically you'll see, like all these things at the top, the structure, you can't accelerate depreciation on the walls and the core structural capital, components of a house. But things like appliances, you go buy a new fridge, or even the fridge that was in the house that you just bought, you can write it all off in the first year if you want to. The carpet, like I said, ceiling fans, removable flooring, not your hardwood tile, but if there's some kind of like vinyl flooring, you could write that all off in the first year. Same thing, if the house has a deck, that costs, a decent amount of money. If you buy a rental house that has a deck, you can write that deck off in the first year. You don't have to replace a deck, you can just take a first year deduction for it. So by going through and actually like doing the work and these numbers are just unique to this particular property. I mean, you can drive some really large, tax savings by doing it. So anybody have any questions on that? I know that was a lot, and I get really excited about stuff like that.
How does HOA come into play? Because that's an expense in certain instances on rental properties and communities. Does that?
Tax deductible.
Yep.
Yep.
Yep, it's part of your expense of running that property, so that's fully tax deductible. The other example, or part of this example here too, is that back to Dean's question, if year 3 you need to replace the heat pump, what happens then?
If you're 3, you need to replace the heat pump, and you've gone through the exercise of identifying these components, and you assigned a value of $5,000 to the old heat pump, and you hadn't fully written it off in year 3, you'd just taken, maybe $300 or something worth of depreciation. You can write off the remainder of the old heat pump and then start the clock on the depreciation of the new heat pump. Anytime you scrap anything and there's a value still, if you still have kind of basis in that asset, you can write off what's left.
Right. So it doesn't theoretically cost you the whole expense. It does, but you gotta write a check for it.
Yeah,
So
but
it does
again,
cost you.
I go back to, that paying cash versus having leverage or having debt on the property, on that $200,000 example, if you took bonus depreciation and if you've almost recouped your full $25,000 in the first year if it's done correctly, and then you've got, many years of cash flow and whatnot to follow, hopefully. So, and that number, what you recoup is the same, whether you have debt on it or not.
So, where's the hand up?
Yeah, so I guess my question is, how do you assign like the amount? Like, let's say you have like an old appliance or old carpet, like you just kind of look and like, oh, I think it's worth this, or how do you know how much
To do like a
write
schedule
off?
like that. So if you're in the business, you can, if you've been in the business and building business and stuff like that, and you've seen a bunch of you've done those improvements and you've seen a bunch of houses, a lot of times you can go in and you can sort of assign those values. There's also some third-party tools that will help you with the calculations. It'll ask questions about the square footage of the house, whether it has carpet or vinyl or hardwood in the various rooms, how many bathrooms, how many ceiling fans, are there mini blinds, are there mini blinds, are there vertical blinds, are there no blinds? So it'll get all this data on the house and then try to kind of come up with approximate values. You always run the risk that a value could be challenged, so I would say make sure that it's within reason. If they assign a value, or if a value is assigned of $2,500 on appliances, and you're like, oh no, there was just one busted fridge in there, it's not going to fly. So you want to make sure that you get as close as possible to the values of those components that you can.
Any other questions on that part of it? You wanna go, you got a minute to go through 1031s real quick?
Anybody ever done a 1031? So 1031 is great. I would say the first question I get is, can I exchange, and a 1031, just a quick overview, is you sell a piece of real estate that is appreciated in value. If it hadn't appreciated, there's no point in, there's no gain to defer. So if you sell a piece of real estate that's appreciated in value, you cannot touch that money. You could send it to what's called a qualified intermediary, which is just basically a bank that holds the proceeds from the first closing, and then you could purchase a replacement property and not have to pay any tax on that initial gain that you had in the property that you sold. The main question one of the main questions I get is, can I exchange a rental property for raw land? Can I exchange a rental property, or a single family home for, you know, an apartment, or, you know, some other kind of type of real estate? And yes, as long as it's real estate and it's held for investment, you can do that. Can I exchange my rental house for my second home? I want to place at the river. No, you really need to kind of wait. There's a 2-year holding requirement where it needs to continue to be held for investment, to not jeopardize, you know, that 1031 exchange. So anyway, it's pretty simple. You know, you sell your house, all the proceeds, you sell your investment property, all the proceeds go to a QI. The QI basically sends those funds when you close on the replacement property, and there's no tax. Whatever your basis was, whatever you paid for that initial house that you sold, kind of stays with you, you know, into the next property, unless you put more cash in. But I mean, it's a great way, you know. I've seen it recently with folks that they bought a great rental, but the value's just gone up tremendously, and they're ready to diversify. You could go from 1 property to 2 properties, you know, just to kind of spread your risk out a little bit. It's not because they bought a bad property, it's just that maybe it's appreciated so much that the rent that they're getting, you know, it doesn't justify continuing to hold it when they could go into potentially 2 different properties going forward. So it's a great strategy. You know, I think that's something that, if I were you, just kind of having in your back pocket, in your toolkit, if you're talking to anybody that's a real estate investor, you know, it's good to kind of know the basics of a 1031.
Yeah, and just make sure you understand that you gotta invest back into the equal or greater amount than what you just sold for.
Yes.
So if you sell the property for, in the example, you sell it for 300,000, you've got to invest in at least 300,000 of other property. You can't invest in less. Yes.
Is this something that needs to be done though, if the capital gains are below the threshold of the sale of the property?
I'm not sure I understand.
Well, you know, capital gains for a jointly filed, you know, couple is $500,000, right, on the sale of a property.
Oh,
So-
so this would not be for your primary residence.
Oh, okay.
This would only be for an investment property.
Yeah.
Okay,
Yes.
thank you.
Yes.
Yeah.
Good clarity.
It would only be for an investment in real estate.
I know there's a lot of terms and a lot of stuff that Margaret and myself just went over, but any kind of questions, and trying to be respectful of time, and thank you guys for the questions already, but any other kind of questions that maybe we can answer for you guys?
So I just did, go ahead. I just did a 1031, and the guy sold like a 1.5 and bought a 750. I mean, he can do that, he just has to pay taxes on, like, how does that work?
Yeah, if you don't want any taxable gain, you gotta equal that. If you want anything, and Margaret's gonna be able to tell you in better words than me, but, so I'll let you.
Yeah, anytime you get cash back out, you've got to pay tax on it, basically.
Yeah.
It's called boot, and it's okay. You can still potentially defer a portion of the tax, but anything you take back out, you got to pay taxes on it.
Correct.
Do you need to do that in the same financial year?
What's that?
Do you need to do the transaction in the same financial year?
Oh, that's a good point. Okay, so if you sell, let's just say you sell a rental house, you have 45 days, and the money goes to a qualified intermediary. So it's not in your checking account, it's with a third party. You have 45 days to identify what you're going to buy. So you don't have to have bought it within 45 days, but you have 45 days to identify. And then 180 days, so 6 months from the date that the property that you sold closes, you have to have bought that replacement property. So those are the restrictions around.
Can technically go into the next year?
You have to, if it drags into the next year by April 15th, which is the individual tax filing deadline, that's your cutoff. So you could have less than 180 to actually close. I've only seen one that kind of got caught in that. But a lot of times what people will do is during that 45-day window, they might say, well, I'm either gonna buy a townhouse here, I'm gonna buy this property or this property. You can identify multiple ones as potential options. You just have to have eventually closed on one of those within 180 days.
Is it okay without using 1031 exchange? If I buy the other investment property within the 6 months, can we avoid the taxes on the capital gains?
All right, say that one more time.
If we don't use the 1031 exchange, if I buy the another investment property within 6 months, 180 days,
No. You have to have identified it in the 45-day window. So you can't just say, I got the funds back and I'm gonna buy another one within 6 months. It has to have, you can't take receipt of the funds and you have to, within 45 days, say which specific property, name the address of the property that you're gonna buy.
And somebody asked if there's a 300 level class. This would be the starting point of a 300 level class, would be talking about 1031s. Also about how you can take advantage of paying capital gains on some income in real estate as opposed to, and it has to be real estate from properties, on how you take advantage of capital gains rates, as Margaret had talked about before, as opposed to ordinary income rates, which again, depending on the bracket you're in, could be almost double the expense of the, so those are really important to know, especially if you wanna buy a property, fix it up, maybe rent it for 6 or 8 months and get past a year from when you bought it, then you could maybe sell it after that year and take that income as capital gains taxes as opposed to ordinary income. But you have to hold the property for at least a year in order to do things like that. But anyway, there's some other things we can talk about down the road. But again, hopefully some of this is a little bit helpful to you guys. I know that a lot of numbers and terms and things like that, but hopefully you get the idea is that rental real estate, in my opinion, is just something that, especially as realtors, as Margaret had said, we need to figure out a way to make that part of your financial plan and actually ends up being part of your net worth and financial worth in the long run. So anyway, but thank you for having us. I hope you guys have a great day.